Hello and welcome to the Eclipse podcast, the Commodity Playbook. This is a channel for the entire commodity trading industry, including the next generation of traders looking to break into the space. From the trading floor to entrepreneurs, we interview market experts and traders to navigate the latest industry trends. Our mandate is clear. We aim to provide greater transparency and better access in an opaque and cyclical market. Today, I'm joined by another esteemed energy analyst, John Kemp, the editor of J. Kemp Energy and the Best in Energy newsletter. Welcome to the show, John.
Thank you for having me on, Max.
Now, John started his career as the international economy editor at Oxford Analytica in 1996, and in 2001 joined Sempra Metals as a senior analyst. Between 2008 and 2024, John was at Reuters, also a senior energy analyst, covering what you were responsible for the oil, gas, electricity,
power, and the energy transition.
Right. So first up, I think we're going to start with the oil market. We've seen a recent shift to bearish sentiment from oil traders. How do you interpret the mixed positioning in the oil markets in the first half of this year? And what factors might contribute to the bearish signals in the short term and the long-term bullish fundamentals?
Yeah, well, I think the market in many ways is stuck between, it's stuck between a bullish narrative, which is based essentially on the likelihood of much tougher US sanctions on crude coming out of Russia, Iran, and Venezuela, which would restrict supply and drive prices higher. But at the same time, a lot of bearish sentiment, which is mostly about concerns about the new tariff regime from the United States, a more unpredictable policy-making environment, and the potential for that to sort of spill over into a loss of business confidence and potentially a slowdown in the economy. So I think the current pricing and the current positioning is that sort of that no man's land. The market not quite sure whether to put the focus on the bullish factors, which mostly sanctions, or the bearish factors, which is the sort of the macro environment. And actually, I had a look before we came on today. I mean, the most recent hedge fund positioning in crude and products is about 540 million barrels net long, which is almost exactly the average for weekly positions going back to 2011. So that suggests to me that this is a market that lacks any sort of strong overall direction.
Can you highlight some of the key takeaways from your 10th annual oil survey?
So the survey was really interesting this year. I've been running this exercise now. I've been running it for a decade. And each year I ask all of my market contacts what they think the average price of Brent crude will be in the current year and each of the 4 succeeding years. So we get a 5-year time horizon. This year, the consensus, the average price forecast for 2025 was about $75 a barrel. And it was also $75 a barrel in each of the next 4 years. So the market's seeing prices very much anchored around about current levels. That is...
And previous levels. No.
And well, previously, I mean, that's down by about $6 or $7 a barrel over the whole time horizon compared with last year. And interestingly, that's also a little bit below the long-term real average. Once we adjust for inflation, Brent prices have averaged about $90 since the turn of the century. So, the market is anticipating, the trading community is anticipating that the market will remain relatively well supplied this year. Prices a little bit below perhaps the average. Certainly there's no strong sort of bullish expectation out there at the moment. And again, I think that's because there are some bullish indicators. The sanctions is a potential bullish factor, and And interestingly, oil inventories are below average at the moment, but that is offset by this tremendous uncertainty about the macroeconomic outlook. And also maybe a little bit of uncertainty about the outlook in China, both from a macro point of view, where the economy is clearly still struggling, but also at a sectoral level where we have seen a potential peak in gasoline demand, a potential peak in diesel demand now coming because of this huge rollout of electric vehicles. So, that seems to be, as the result of all that is that prices are expected to be sort of a little bit on the low side over the next sort of 1 to 5 years.
That brings me on nicely to my next question about geopolitical influences. How are the tightening US sanctions on Russia and the potential reimposition of maximum pressure on Iranian exports to impact global oil supply and prices?
Well, both of them could take a significant amount of oil off the market. It does depend. I mean, at the moment, all the Russian barrels and the Iranian barrels are essentially being directed to China and to a lesser extent to India. There is a question about how far. I mean, both India and China have indicated that they disagree with unilateral American sanctions. There is an open question about how much they will comply. Indian oil buyers probably more likely to comply with American sanctions. The compliance by purchasers in China is a little bit more obscure. But yes, there is the potential to take quite a large number of barrels off the market. But the assumption then would be that gap would be filled both by an increase in production by Saudi Arabia and some of the other Gulf OPEC members, and also potentially over time an increase in production from the US shale industry. So I think the sanctions, there is an obvious attraction for the new administration in the States of imposing the sanctions, because in some ways you tighten the market and you potentially create some growth opportunities for the US shale sector to sort of step in and supply barrels that formerly came from Iran and Russia.
What are the potential implications of US sanctions for Asian refiners and the global oil market structure?
It's very challenging for Asian refiners. I mean, they've become very heavily dependent upon cheap crude from Iran and Russia. So it is very challenging. I mean, I think most Indian refiners have shown a very high propensity to comply. They have a lot of exposure to the US financial system, to US oil companies, to US banks. So they are very reluctant to jeopardize that. So there is I think, a presumption of compliance on the part of Indian refiners. China is a little bit more complicated. The major state-owned refiners in China, I think, have, again, a very strong incentive to comply. They have a lot of exposure to the United States and the US financial system. Traditionally, the smaller independent refiners have been far less willing to comply with US sanctions. They don't have that exposure directly to the US financial system. That said, there's almost always some form of indirect exposure. The banks that they deal with will deal with US banks or at second or third remove. So there has tended to be, there may be some, at least in the short term, I think there may be some hesitation about buying cargoes that flagrantly contravene US sanctions. Whether in the longer term, as the focus shifts elsewhere, there might be a little bit more willingness to buy those cargoes, I think that's quite likely. And particularly if oil prices start to rise. If sanctions if the reimposition of sanctions tightens the market significantly, oil prices start to rise, the incentive to find workarounds to circumvent the sanctions obviously increases.
And there's still some uncertainty around oil imports from Mexico and Canada. Trump obviously slapped 25% on other goods. What's the picture there? Is there any clarity around, is it 10%? Is it?
It's no surprise, I think, that the administration has moved to impose tariffs on Canada and Mexico. I mean, that had been signalled, and I think one of the things that the administration is keen to do is to establish a reputation that we do what we say. I do think they were somewhat disconcerted by the signs that would potentially trigger quite a significant correction on Wall Street, the opposition from the US business community, and the fact that both Canada and Mexico indicated that they would retaliate immediately. So I think the administration was, a little bit disconcerted by that. And I think that when Canada and Mexico offered some sort of minor concessions around border security, the administration was quite quick to take that off-ramp. So, I think what I think the weekend showed was both the usefulness of tariffs in terms of dramatizing an issue and getting other countries to take it seriously, but also the limitations if it sort of threatens to tank the stock market or potentially create a domestic economic downturn. So I think it highlighted both the strengths and the limitations of a tariff policy.
So the oil market shifted into deep backwardation, driven by the geopolitical factors and supply concerns we've just been talking about. How sustainable is this backwardation, and what does it indicate about the current and future state of physical oil balances?
I mean, normally we would see backwardation as consistent with a tight market, one in which inventories are low and declining, and that is indeed what we are seeing at the moment, that inventories are below average, and there has been some downward pressure. So the backwardation is not entirely surprising. Before coming to speak with you today, I went back and I had a bit of a look at that, and the current backwardation for Brent, which is about sort of $3.25 over 6 months, is roughly is about in the 80th to the 85th percentile for all trading days going back, to the start of the century. So quite a severe backwardation, and suggests that the market is quite severely undersupplied. That said, we've traded pretty much continuously in backwardation now since 2021. We've only traded in contango on a couple of days since 2021. And that to me suggests that we have moved into a new kind of market regime. And if that is the case, then we may be the backwardation may be making the market look tighter than it actually really is. In terms of what might be driving that new regime, I suspect that what you're seeing is the impact of OPEC policy, that the OPEC plus policy led by the Saudis has been to keep inventories deliberately low, and they have succeeded in doing that. And the consequence of that is that they've succeeded in keeping the market pretty much in backwardation continuously. There's been a cost to that in terms of the Saudis have conceded a significant amount of market share, but they have managed to keep inventories low. They have kept the market in backwardation, and they've kept prices at a relatively high level. I mean, I think they would probably prefer a price significantly higher than $75 a barrel, but we haven't seen a sort of price collapse. Even last autumn, where there was concern about the economy, we didn't see prices collapse down to sort of $60 or $55 a barrel. So I think the Saudis have kept the market fairly tight, kept control, and that's what the backwardation is showing us.
Despite the risks of supply disruptions, OPEC is not expected to increase supply preemptively. What might be the strategic considerations behind this decision, and how could it affect the market dynamics in the coming months?
Well, I mean, OPEC policy over the last sort of really the last 10 years has been to be very proactive and preemptive when the market is under pressure and prices look like they are falling, but to be much more reactive and take a wait and see approach when the market is tightening. So I think you're absolutely right. It's very unlikely that they are going to bring forward the planned production increases unless and until they start to see, prices rise. As I said before, I mean, prices at the moment are still, quite a bit below average. The long-term average would be $90 a barrel, maybe. And I think they would, most OPEC countries would prefer to see them much closer to that before they start to increase output. And maybe even higher. I mean, Saudi Arabia has some very expensive, economic transformation programs to pay for. NEOM is absorbing, tens of billions of dollars of expenditure. So I think the Saudis would definitely like a higher price than this. I think the same is probably true for most of the other, OPEC plus members. So I don't think they're going to be in any rush to raise production. Assuming that the maximum pressure campaign against Iran takes sort of maybe 1 million, 1.5 million barrels a day off the market, it is likely that prices will start to increase. And eventually I would expect, that, if Brent reaches sort of $90 a barrel and is sustained at that kind of level, it may be that OPEC Plus decides to sort of unwind some of its production cuts a bit faster. But certainly until we reach that kind of level, I don't think I think OPEC will stay with its current plan of gradually increasing production over the balance of 2025 and 2026.
I'm going to move on now to US natural gas. And we're going to talk about the impact of weather on natural gas prices. So how has the recent extreme cold weather influenced the US natural gas market, and what are the potential long-term implications for gas prices and storage levels?
So interestingly, US gas inventories have dropped below the seasonal average for the first time in 2 years. That was about a week ago. So the enormous surplus that was carried over at the end of the very mild winter of 2023-2024 has now fully disappeared. There was about 634 BCF of surplus gas at the end of March 2024. That's finally all been absorbed. There are, I think, 4 factors that have been driving that. One, as you say, has been the recent cold weather. It's only been an averagely cold winter so far in the United States, but that's quite a lot colder than last year when we had, record warmth. So that has helped tighten the market. A very long period of very low prices has created a downturn in US gas production. US gas production has fallen for the first time since 2024, fell for the first time since 2016, and before that 2005. So we did see a slowdown in US gas output last year. We saw a little bit of an acceleration in exports, LNG exports, though it wasn't as fast as we were expecting at the beginning of the year because there were some production problems. But the most important factor was a huge increase in the amount of gas-fired electricity generation. Those ultra-low prices last year encouraged anybody who had a gas-fired unit to run it for the maximum number of hours last year. In fact, it wasn't just the CCGTs that provide the base load of power that were running exceptionally hot, an exceptional number of hours last year. We saw that prices were so low that even single cycle turbines and peaking plants were operating at record rates for much of last year. So that probably more than any other factor has helped sort of absorb that surplus gas. Already we're beginning to see that as that surplus has disappeared, prices have begun to rise. In real terms, they've doubled over the last 9 or 10 months from the low point back in March last year. And a lot of traders are expecting them to continue rising this year. We've seen a very large hedge fund net long position in the US gas market, highest that we've seen for 3.5 years. And the expectation is that prices will need to continue rising because we need to restart growth in domestic US gas production, and prices need to be a bit higher to sort of restrain the amount of consumption by electricity generators.
So given hedge funds and money managers are taking this bullish position in Henry Hub futures, what does this indicate about market sentiment? I know you touched on it there, but how might it affect future price movements?
I think the sentiment is extremely bullish. There has been a very large drawdown in surplus inventories, and that drawdown has now become unsustainable. So we do need much faster growth in gas production, and we need much slower growth in consumption, particularly by the generators. The market also has to make room for a further increase in LNG exports this year, and another increase and a bigger increase in 2026. So for all of those reasons, we are likely to move into a much higher price environment. Prices are still quite low. I mean, we reached the lowest level in inflation-adjusted terms for 50 years last March. So it's not really that surprising that we've seen this big turnaround. But prices are still below the 30th percentile in real terms. So there's probably quite a lot more upside potential, and that's what I think most hedge fund managers have sort of latched onto. It's one of the most bullish trades at the moment in the energy markets.
Given that higher prices alone are insufficient to drive meaningful supply growth, what strategies might producers adopt to balance production with market demand?
I mean, I think it will ultimately. I think it will be driven by a much higher price environment. I mean, there are obviously hopes that the new administration in the United States will ease some of the burdensome regulations on domestic gas production, and that might spur slightly faster growth. But I think the impact will be very marginal. Ultimately, it is going to the renewed growth in production is going to have to be driven by an improvement or an increase in prices. We're currently trading a little north of $3 per million British thermal units. And I think we're probably going to have to trade north of $4, on a sustained basis to just get that industry growing again.
A bit about demand side dynamics and LNG growth. How is the expected growth in LNG feed gas demand likely to impact the natural gas market, and what role will this play in shaping trends throughout the year?
I mean, LNG growth was quite small last year, basically because a number of the liquefaction plants experienced technical difficulties that took them offline for periods. We would expect much faster growth in 2025. A couple of new liquefaction trains started up at the end of 2024 and the beginning of 2025. So that should also cause LNG exports to rise this year. And then we have more plants scheduled to start up over the remainder of this year, and particularly in 2026. So that is going to cause the market to tighten quite a bit. And again, I think that is, going to be a key source of upward pressure on US gas prices. Over the longer term, we would expect that gas prices in the United States will converge more closely with those in Europe and Northeast Asia. The convergence won't be complete. Because the liquefaction facilities will remain a bit of a bottleneck, but you would expect to see the extreme discount that we've had for North American gas prices to diminish.
Do you think Europe can soak up the excess LNG as they try and move away from their reliance on Russian gas?
Yes, I think that's very likely. And I think, as it is extremely likely, I think that one way for the European Union to try to offer a concession to the Trump administration to avoid the imposition of tariffs will be to offer to try to take more US LNG, probably tightening sanctions on Russian LNG to create space in the market for an increased offtake from the United States. And we've also seen, of course, that in the last few days that China has imposed tariffs on US LNG, on LNG imports from the United States, which will largely shut US LNG out of the Chinese market, which means that, again, all American LNG is basically going to be directed towards European buyers.
This dovetails quite nicely with our next topic, European gas and storage. So we'll talk about the supply risks and more of the geopolitical factors, because considering the potential loss of Russian pipeline supply through Ukraine and the impact of new US sanctions on Russian LNG facilities, what strategies should European countries adopt to mitigate these supply risks?
It's been a very challenging winter for Europe. And it looks like it's going to be a very, very challenging summer. That inventory levels, for the last couple of years, inventory levels have been well above average. So after that spike in prices in the immediate aftermath of Russia's invasion of Ukraine in 2022, which pushed prices up to an extreme level, they did retreat back to something that was a little bit more normal. But those excess inventories have also disappeared this winter, partly because we've had much colder winter than the last couple. Europe got very lucky for 2 winters, and our luck has run out this time. We've had a much colder winter. We've also had a winter that has had long periods of very still weather, low wind speed, low Dunkelflaute. So we've had higher heating demand, lower wind generation, so you have a double hit in terms of the demand for gas, and that has drawn the inventories down quite rapidly. We've just about, there are targets for 2025 that the EU has set that storage should remain at least at 50% as of the 1st of February, at least at 30% as of the 1st of May, and then should refill to at least 90% by the 1st of November. But there were slightly higher sort of optimum targets, so 55% on February the 1st, 45% on May the 1st, and obviously 90% by November the 1st. We've just about hit that February target, but with much more difficulty than people were expecting. We are going to face a very much more challenging refill season this summer. The European storage operators are going to need to source somewhere between an extra 20 and 45% more gas to refill their underground storage facilities this summer compared with the 2 previous summers, and that's put tremendous upward pressure on summer prices, driven the market into a very large, a very unusual backwardation with futures prices for summer 2025 trading at a premium of 5 or even 6 euros per megawatt hour over prices for next winter. So that stress has become very evident. And there is a real concern that the market will struggle to source enough gas this winter to be able to meet that storage target of 90% by the beginning of November. There have been reports over the last couple of days that European regulators have started to discuss relaxing some of those targets a little bit to take some of the heat out of that market and give the market a little bit more flexibility in terms of how quickly it tries to rebuild storage. But yes, after 2, Europe got very lucky for the last 2 winters. This winter, its luck has run out, and we've seen the market tighten considerably. That raises the current prices for both gas and electricity across the EU and indeed the UK are unsustainably high. They're clearly causing a fairly severe degree of deindustrialization, with a lot of energy intensive industry essentially unprofitable at these kind of price levels. So that raises a longer term question for the EU about how you bring gas and electricity prices down, and that's a very challenging one. One option may be to try and buy more LNG from the United States. And that clearly fits into the geopolitical strategy of trying to sort of build a positive relationship with the Trump administration. But that LNG is likely to remain quite expensive. So the other issue that is now sort of, I think, being discussed in the background is whether to restart pipeline flows from Russia as part of any eventual sort of peace negotiation between Russia and Ukraine.
Trump won't like the sound of that, though.
Sorry, what's that?
Trump won't like the sound of that.
Well, that's it. I mean, you've got two problems.
Because of the excess LNG that they're trying to sell.
Absolutely. So, it is very difficult. I mean, there's a really big tension here. I mean, obviously, the United States would prefer those pipeline flows to remain sanctioned, to be able to sell more LNG to the EU. But equivalently, it's very difficult to see. I can't see circumstances in which the Russia-Ukraine conflict comes to an end and the Russians are not allowed to restart any pipeline flows to the EU. Seems very unlikely that Russia would agree to a ceasefire or to a peace settlement that did not allow them to sell at least some pipeline gas or LNG into the EU. So there's a bit of a tension here between sort of foreign policy objectives. I wouldn't expect those pipeline flows to restart anytime soon, and if they do restart, I think they might restart on a fairly small scale basis. But I do think that's something that the market will have to think about sort of later in 2025 or possibly in 2026.
I saw that Nord Stream 2 might be back. Did you see that?
Well, I mean, the lines that have been blown up, I don't think are going to restart anytime soon. I very much doubt that will be repaired. But flows through the other pipelines that have not been damaged could restart. And the same with transit gas across Ukraine. It's very possible that part of any eventual, negotiations or negotiated end to the conflict involves the restart of at least some Russian gas exports, pipeline flows, or alternatively that some of the sanctions on Russian LNG are lifted. I mean, I can't see either of those being particularly popular in Washington, but equivalently, I can't see any circumstances in which Moscow would agree to a settlement that leaves all of the energy sanctions in place.
It doesn't bode well for Trump ending the war in 24 hours.
No, it's quite complicated, and the same, to be honest, is going to be true for oil. I mean, it's very difficult to see circumstances in which there is a negotiated end to the conflict, and Russian oil exports all remain subject to the current level of fairly stringent sanctioning. So if you believe that there's going to be a negotiated end to the conflict over the course of 2025 or 2026, you also have to reckon with the possibility that more Russian oil and gas will make its way onto international markets over that time frame.
Moving on now to power sector transition. With this significant drop in gas demand from the power sector due to the increase in solar capacity, how do you anticipate the energy mix in Europe evolving over the next few years?
I mean, the energy mix is clearly, we are moving towards a system where effectively, solar and wind generation will provide an increasing share of total generation over the course of the year, with gas-fired power then essentially acting in an auxiliary or backup role. That means that, in the summer months, a very high share of generation is going to come from the solar sector, and in the shoulder seasons, spring and autumn, a very high share of generation is going to come from wind. But there will be periods of the year, as we had this winter, the Dunkelflaute, where the system will then have to sort of revert back to gas-fired power. What I think that means is we're going to see a lot more volatility in prices. That you are going to see, as we saw this winter, you may see a price profile where prices are on average much lower than they have been in recent years, but where there will be specific, short periods of time during the year when prices rise to a what we might consider a very extreme level in order to incentivize those gas-fired power plants to run, and in order to pay for the capacity, because what we will have in the end is gas-fired power plants that will sit idle for very much of the year and then have to recover not only their operating costs but their capital costs from running at very high prices for a small number of hours each year. So I think that we are moving towards a sort of a system that looks very different to what we've had in the past.
And what about green hydrogen? Is this just a pipe dream still? I know industrial scale bankability still isn't there, but can that help dovetail the transition?
I'm a very big skeptic about the outlook for hydrogen. I think there will be certain areas where hydrogen could become a key energy carrier. It may be a way to decarbonize certain heavy industries. It could replace natural gas, for example, in some of the sort of steel making, ceramics, glass making sectors. But I do not foresee hydrogen playing a wider role in terms of domestic and commercial heating or electricity generation or anything like
transport.
It's the challenges with hydrogen are very well known. It is very challenging to store, but more importantly, it's very challenging to distribute through a transmission and distribution network, and is very costly. And I don't think it will be cost competitive at any point over the next sort of 20 years. So hydrogen will end up, I think, having a small, very specific role, basically as an energy carrier and a fuel for industrial clusters, and particularly for extremely energy intensive industries. But in the wider economy, I don't see it playing much of a role.
Unless it can piggyback off the existing gas infrastructure.
But it's really difficult, because that gas infrastructure is not really designed to operate safely with hydrogen. The problems of sort of pipeline embrittlement, the problems of needing to retrofit domestic burners. I mean, you might be able to mix a low percentage of hydrogen into the city gas supply, but it's unlikely to be high enough to make any sort of significant difference. If you really wanted to switch everybody's, heating systems, etc., over to you would. It's an expensive retrofit program, not just for the customer equipment, but also for the pipeline and transmission network. So I think it's very difficult to see that being a cost competitive pathway to sort of decarbonising the system. I think there are other ways of doing it that will be cheaper, much more likely to be through electrification, I think, than hydrogen as a pathway.
Okay, so more pipe dream than pipeline. Yeah,
Yeah.
I'm with that. I'm with you. Storage and market dynamics for European gas. With Europe starting 2025 with less gas in storage and the need to meet end October storage mandates, what are the implications for TTF prices and LNG imports?
I mean, much higher TTF prices this summer, and that's where the market's already gone. I mean, we're trading north of 50 euros a megawatt hour at the moment, both for the front month contract, but also for the summer contracts, and that is precisely because traders anticipate it's going to be a much more challenging refill season. So, in many ways, what's happened is that the market has already sort of anticipated, accelerated, and perhaps exaggerated that difficulty of a summer refill, and that's reflected in prices now. The market is trying to conserve every possible molecule it can in the remaining sort of 2 months of the winter season, to try to limit the amount of extra gas that's going to have to be purchased over the summer, because it could be a lot more challenging, and it could be a lot more challenging for a couple of reasons. One is that Asia will also be in that market, so the Europeans will be competing directly with customers in Japan, Korea, China, but also India and South Asia. And two, the Americans, the American market, as we discussed before, is also tighter at the moment. So you're going to be needing to pull more molecules out of North America at a time when they no longer have surplus molecules to sell. So it is going to be a very much more challenging refill season, and that's why prices have risen so much. The futures market has already anticipated that problem. And is in many ways on its way to solving it. I mean, that these kind of prices, I would expect to see more industrial shutdowns, more industrial users saying, we simply, our plants are not economic at these prices. That saves you quite a lot of gas. We will see less gas-fired generation over the balance of this winter and into summer. So that makes that will solve your problem. The price is solving the problem for you, basically, but it's in a very uncomfortable way.
Do you want to have a little guess at what might be the entry point for traders price-wise?
Oh, I think the entry point has long since passed. I mean, the entry point for was, I think we started to see back in sort of November, December, that the inventories were depleting much more quickly than they had in previous winters. And that's what's carried the price up from sort of 32 euros to, 53 euros earlier this week. I mean, I think that part of the trade is complete. The question is, or is now, significantly completed. The question, I guess, going forward is the economic and political pain in Europe now so great that that it makes the Europeans more willing to consider a resumption of gas imports from Russia, either later in 2025 or at some point in 2026? I mean, there are two dimensions to the pain. We had really intense pain back in 2022 in the immediate aftermath of Russia's invasion of Ukraine. You saw prices, gas prices surging to, over 300 euros per megawatt hour. But what made that pain a little bit more bearable? Two things. First of all, political and moral outrage at Russia's invasion of Ukraine, and a feeling that something had to be done. And secondly, the belief that the high prices would be relatively temporary, that if we could just get through that first winter of 2022-23, that prices would come down. The problem now is that prices have come down, but they've stabilized at what was previously an extremely high level at which industry is not competitive. Germany's energy intensive industries have not bounced back. Production is still 15% below where it was before Russia's invasion. So, the pain, although it is less intense, has now become much more chronic, and it's now becoming a fairly significant political issue. And the question is, has the pain now lasting so long that it is becoming unendurable for European industry, but also for Europe's political class? And does that mean that the political class starts to look at, well, what are the options to bring gas prices down? How do we bring gas and electricity prices down to a more tolerable level? Does that mean relaxing some of the sanctions on gas imports from Russia? Is that the concession that Europe offers as part of an eventual Russia-Ukraine, peace negotiation or ceasefire deal? It has. I suspect it has to be on the table, both because I don't think Russia will reach an agreement if some sort of sanctions relief is not offered, but also because I think it is absolutely critical for European industry and for the European political class to be able to show that energy prices are reverting to something more tolerable. So I think that for me is that's the wild card. That's the key unknown for later in 2025 and 2026 is, will we see some sort of ceasefire agreement between Ukraine and Russia, and does that involve some degree of sanctions relief on the gas side for Europe, but also on the oil side, which has obviously more global implications.
And finally, how do you see the balance between storage requirements and global LNG market tightness playing out?
It's going to be a very tight year for global LNG. Europe's going to need to buy quite a lot more. It's going to need, the refill requirement for the summer of 2025. By my estimates, the refill requirement is going to be about 45% higher than it was last year, and about 20% higher than it was in 2023. So they're going to need to buy a lot more gas. That is going to put quite a lot of strain on the LNG market. The development of new LNG export projects in the United States has fallen behind schedule. So where we previously saw a surplus in the global LNG market in 2025, that sort of so-called wall of LNG, that surplus has been pushed back to at least 2026. So it's going to be another quite tight market this year, which means quite high prices, which again feeds into that discussion about what could policymakers do in the short term or the medium term to bring prices down. The short-term fix at the moment for the Europeans is to fiddle with the storage targets, to give people a little bit more flexibility in terms of how quickly they refill storage this summer. But that's not going to bring you very much relief. The medium-term question is, do you try to, import more from Russia, or do you try to, ease the sanctions in some way? And as I say, potentially offer that as a carrot to Moscow to say, look, if we can reach a tolerable agreement that both Russia and Ukraine can accept as a ceasefire, then the EU contribution to that would be some sort of sanctions relief on either gas or oil. And then you've got to sell that. You've got to sell that concession to the Americans, because obviously they have a strong commercial interest in that outcome as well.
Tricky when they're brokering the deal as well.
And it's very, very tricky. It's the European energy predicament has become really quite serious. For much of the last decade, or at least for the decade prior to Russia's invasion of Ukraine, the mood music was that decarbonisation, that the EU, that Europe being a leader in sort of the energy transition would lead to lower energy prices in the continent and would be a source of comparative advantage, a competitive advantage. The problem is it's turned out to be completely the opposite. In fact, now Europe's high energy prices, partly as a result of its energy transition policies, partly as a result of the conflict, has become a source of competitive disadvantage and is leading to sort of fairly rapid deindustrialization. And that is then sort of creating a sort of political knock-on effect, which you've seen in Germany, but you've seen also more widely across the region. So somehow or other, Europe has got to come up with a strategy that leads to significantly lower gas and electricity prices, I would say over the medium term, by which I mean over a 5-year horizon, but arguably the political imperative is that those prices need to come down a lot faster, that you need a plan that can lower gas and electricity prices over a sort of 2-year horizon.
John, thanks for joining us on the show.